Yo, what's going up, everybody? What's going on, everybody? It is Tuesday, April 4th. March finished up really strong. I mean, we had a 733 billion monthly flow, spending flow in March. That was the most since March 2021. We're talking about, these are big numbers, folks, big numbers. The problem is now we have peaked out, and of course we are facing the April tax drain, which is coming up in about another 10 days or so. And that is going to have a negative effect on the market. We may already start to be seeing that right now in the pullback. That could be just people liquidating stocks, maybe in anticipation of paying taxes. I don't know. But these are the quarterly April tax drains, and this is the biggie. This is April 15th or whatever day it comes on, April 17th or 18th this year. I don't know. So we have that to contend with, which is not cool, but I'm not, that's not something I particularly worry about. I anticipate that it is going to cause some volatility and pullback in the market because, you're draining out that swimming pool. You're draining out that swimming pool. The bigger problem is still the debt ceiling, which is out there. It looks like in June that has to be resolved. If that is not resolved, I've spoken about this before, then it raises the likelihood of a recession and an ongoing recession in the economy. I mean, if it comes to that, if it comes to the point where, no deal is done on that and Treasury has to rely on tax revenues coming in and, they're going to have to make some spending cuts, and then people are going to go out, it's a vicious circle. It's the opposite of the virtuous circle that we have right now when the government, even though they take in taxes 4 or 5 times a year, and those are uncomfortable periods in the market, that money's spent back out and then some because we run deficits. Under the debt ceiling, that would not be possible, and it would create a negative cycle where you'd see slower economic growth, higher unemployment, less taxes. Less taxes mean it leaves less for the government to pay its bills, which means slower economic growth or negative economic growth, which means more people out of work, which means less taxes. So, I mean, that's just, we don't want to see that happen. Now, I came into this year, I was probably the only economist out there saying we are not going to have a recession, at least based on the monetary policy situation of rising interest rates. I did not see that as a negative factor because, I've been saying all along that that's just pumping money into the economy. That's like a funnel. That's that water flow, that spigot coming out at a faster and faster rate as the rates go up. Since the government is a net payer of interest, that's just pumping more money out. But if we hit that hard debt ceiling and which is a crazy thing. I mean, that is just like a lunatic self-imposed constraint that we have out there, and it's used every single time in cases like this where it comes down to political brinkmanship. I still hold out hope that they'll get something done, even though I know McCarthy is dead set on doing something. I don't know, he might get some token cuts in some areas that he wants, or I don't know. I'm hopeful. But if we do run into the debt ceiling, then all bets are off. Actually, there's only one bet at that point, and that bet is to be short the market because it's going to go down. I mean, it brings to mind, and I say this almost half laughably, because in 2010, 2011, when Greece was going through its crisis because, went off the drachma and had to cut pensions, had to cut jobs. Everyone said we're going to end up like Greece. And I said, well, that can't happen because the United States is a currency issuer, not a currency user, which is what Greece had become when it gave up the drachma. It went hundreds and hundreds of years in Greece. The country never had a problem paying its pensioners and stuff like that because it paid in its own currency. It might have had an inflation problem now and then. Look, I visited Greece many times when it was under its own currency. It was a wonderful country. But now we can become like Greece if we self-impose that condition on ourselves. And that's the direction we are headed in. So it's completely, to say it's wrong-headed policy is like the most polite way to say it. It is stupid, idiotic, imbecilic, asinine policy to do what we're doing to ourselves. Hopefully it won't come to this, but that's my focus right now. My focus is not on the April tax drain. Yeah, that's going to pull the market down, but that happens 4 times a year, 5 times a year. We recover from that because there's always net spending. If there's not net spending, you're going to see a big, big change in the U.S. economy, and it's not going to be pleasant. I'll tell you this right now. So anyway, that's my wonderful update for today. A little bit short, but see everybody tomorrow. Bye.